Chapter 1. Continuation Regulatory Environment. Audit Committees. Audit committees form part of the governance structure of an organization. The board objectives of an audit committee are threefold: to increase public confidence in the credibility and objectivity of published financial information, to assist directors in meeting their financial reporting responsibilities, to strengthen the independent position of a company's external auditor. The following requirements are taken from the Guidance on Audit Committees published by the Financial Reporting Council, FRC. The guidance is designed to assist company boards when implementing the Corporate Governance Code. Companies with a premium listing are required to comply with the code or explain why they have not done so. Audit committee arrangements should be proportionate to the task and will vary according to size and complexity of the company. All directors have a duty to act in the interests of the company. However, the audit committee must act independently from the executive to ensure that the interests of the shareholders are properly protected in respect of financial reporting and internal control. There should be a frank, open working relationship and a high level of mutual respect between Audit Committee Chair and Board Chair, the Chief Executive, and the Finance Director. Management is under an obligation to ensure the Audit Committee is kept properly informed. All directors must cooperate with the Audit Committee. The core functions of audit committees are oversight, assessment, and review. It is not the duty of the audit committee to carry out functions that belong to others. For example, they should make sure there is a proper system in place for monitoring of internal controls, but should not do the monitoring themselves. The board should review the audit committee's effectiveness annually. Membership, appointment, and skills. The committee should comprise independent NEDs. The committee should have at least 3 members, 2 for smaller companies. The committee as a whole should have competence relevant to the sector in which the company operates. At least 1 member should have recent and relevant financial experience with an appropriate professional accountancy qualification. Committee members should be independent of operational management. Appointments to the audit committee should be made by the board on the recommendation of the nomination committee, taking into consideration the skills, experience, and qualifications to meet corporate governance requirements. Appointments should be for a period of up to 3 years, extendable by no more than 2 additional 3-year periods. New members should receive induction and training should be provided to all members on a continuing basis as required. Meetings. The audit committee should hold as many meetings as the roles and responsibilities require, and it is recommended that no fewer than 3 meetings are held. No one other than the audit committee chair and members is entitled to be present at a meeting of the audit committee. The audit committee will decide if non-members, such as the finance director, head of internal audit, or external audit partner, should attend a particular meeting. The audit committee should meet the external and internal auditors without management, at least annually, to discuss any issues arising from the audit. In addition to the formal committee meetings, the audit committee should keep in touch on a continuing basis with the key people involved in the company's governance. Resources. The Audit Committee should be provided with sufficient resources to undertake its duties. The Company Secretary should ensure information is provided to the Audit Committee on a timely basis. Funds should be provided to enable it to take independent legal, accounting, or other advice when required. Remuneration. The remuneration should take into account the level of fees paid to the other members of the board. The chair will be paid more than the other members to reflect the additional responsibilities and demands on their time. Relationship with the board. The Audit Committee should report to the board on how it has discharged its responsibilities. Where there is disagreement between the Audit Committee and the board, adequate time should be allowed to resolve the disagreement, and the Audit Committee should have the right to report the issue to the shareholders. The Audit Committee should not just rely on the external auditor to raise issues, but should consider matters using their own initiative. Annual reports. The Audit Committee should review and report to the board on the significant financial reporting issues and judgments made in connection with the preparation of the financial statements. Consider the appropriateness of significant accounting policies, significant estimates, and judgments. Review the annual report and accounts and advise the board on whether they are fair, balanced, and understandable. Internal control and risk management. The board has ultimate responsibility for risk management and internal control, but may delegate some functions to the Audit Committee, such as reviewing the systems established by management to identify, assess, manage, and monitor financial risks. Receiving reports from management on the effectiveness of systems and the conclusions of any testing carried out by internal and external auditors. Reviewing and recommending disclosures to be included in the annual report in relation to internal control and risk management. Internal audit process. The Audit Committee should regularly review the need for establishing an internal audit function. Where there is an internal audit function, the Audit Committee should review and approve the internal audit plan. The plan should be aligned with the key risks of the business. The Audit Committee should ensure the function has unrestricted scope, the necessary resources, and access to information to be able to perform its work, in accordance with professional standards for internal auditors. The Audit Committee will approve the appointment or termination of the head of internal audit. The internal audit function should have a reporting line independent of the executive, so it can exercise independent judgment. The Audit Committee should monitor and review the effectiveness of the internal audit function's work. This includes confirming that the quality, experience, and expertise of the function are appropriate for the business. Meeting with the head of internal audit without the presence of management to discuss effectiveness. Receive a report on the results of the internal auditor's work. The Audit Committee may consider an independent, third-party review of the internal audit function's effectiveness. External audit process. FTSE 350 companies should put the audit out to tender at least once every 10 years to enable the Audit Committee to compare the quality and effectiveness of the services provided by the incumbent auditor with those of other firms. The Audit Committee has primary responsibility for the appointment of the auditor, including the tendering process and selection procedures. An annual assessment should be made of the qualifications, expertise, resources, and independence of the external auditor. If the external auditor resigns, the Audit Committee should investigate the issues giving rise to the resignation. The Audit Committee should approve the remuneration and terms of engagement. The Audit Committee should monitor compliance with the ethical standards, including the level of fees former employees of the audit firm who now work for the company, partner rotation, and non-audit services. The Audit Committee should set and apply a formal policy specifying the types of non-audit services which are approved. At the start of the audit, the Audit Committee should ensure that appropriate plans are in place for the audit, including whether the planned materiality level and the resources are consistent with the scope of the work to be performed. The Audit Committee should discuss with the external auditor any matters which could affect audit quality. The Audit Committee should review and monitor management's responsiveness to the external auditor's findings and recommendations, and should also review the written representation letter before it is signed. The Audit Committee should assess the effectiveness of the external audit process, including asking the auditor to explain the risks to audit quality, whether the auditor has met the agreed audit plan, obtaining feedback from key people involved, such as the finance director, about the conduct of the audit, reviewing the content of the management letter and whether recommendations have been acted upon. Communication with shareholders. The Audit Committee Chair should be present at the AGM to answer questions. A separate section of the annual report should describe the work of the committee, specifically a summary of the role of the Audit Committee, the names and qualifications of all members of the Audit Committee during the period, the number of Audit Committee meetings, the significant issues that the committee considered in relation to the financial statements, and how these issues were addressed. An explanation of how it has assessed the effectiveness of the external audit process and the approach taken to the appointment or reappointment of the external auditor. Benefits and drawbacks of audit committees. Benefits: improved credibility of the financial statements through an impartial review of the financial statements, monitoring of the independence of the external auditors, and discussion of significant issues with the external auditors. The quality of management accounting will be improved as the Audit Committee is better placed to criticize internal functions. The control environment may be strengthened as the internal audit function will report to the Audit Committee, increasing their independence and adding weight to their recommendations. Communication between the directors, external auditors, and management may be improved. Conflicts between management and auditors may be reduced or avoided. The skills, knowledge and experience, and independence of the audit committee members can be an invaluable resource for a business. It may be easier and cheaper to arrange finance, as the presence of an audit committee can give a perception of good corporate governance. It would be less burdensome to meet listing requirements if an audit committee, which is usually a listing requirement, is already established. Drawbacks. Difficulties recruiting the right NEDs who have relevant skills, experience, and sufficient time to become effective members of the committee. A fear that their purpose is to police executive management. NEDs may be overburdened with detail. NEDs are normally remunerated, and their fees can be quite expensive, thereby increasing costs for the company. Chapter Summary. Regulation. Need for regulation. Corporate governance. Current developments. ISAs, ethical, legal.